Good afternoon. Welcome to Hidden Levers War Room for March 2019. The Fed's dead. My name is Raj Udeshi. I'm one of the founders of Hidden Levers. I'm joined by my other founder, Praveen Gunta. We have an excellent economic research team here at Hidden Levers, and we're here to bring the straight dope, get above the noise and fray, and maybe give you some macro ideas and guidance that's not really sensationalist around the Fed's new decisions, and they're kind of 180. So today we'll be discussing the anatomy of a rate hike cycle and how that breaks down compared to past cycles, and then talk about the economic headwinds and tailwinds that are around us, a pulse check of the economy here in the United States and maybe Europe for a second to see if that dovishness was warranted. And then we'll introduce a new scenario. Today we are retiring the Fed hawks scenario that's been in place since Chairman Powell was appointed, and replacing it with the new idea of the Fed being dead. Of course, they're still well and alive, but their credibility may be out the window because I'm not sure who they're beholden to, but they're definitely not acting by their own rules. Isn't that right, Praveen?
Definitely. So let's talk about why we've inserted the doves and why we think that maybe the Fed isn't dead, but maybe they simply are on vacation, if nothing else. But first, maybe we can talk about why this topic and why it's ripe now, Raj.
I'm not yeah, so what makes this ripe? Of course, the Fed's random pivot. In December, as the market was crashing, we saw the Fed turn dovish. Absolutely, Chairman Powell was hawk and assigned to being hawk, and even the Trump administration and those voices wanted him to be that. They wanted to get interest rates back to what's called the old normal. High interest rates, meaning 4 or 5 handle, and a GDP that is correlated to that also rising. Those are good things for the economy. No longer. That pivot has been doubled down on in March. So we're just wondering why, because the markets come back and so have oil prices. So it didn't make sense that they would have such a change of character that was so prolonged. The yield curve inverted, that's all the rage. You can Google that. If you don't know that, you probably need a new gig. But that is all the talk these days, and maybe your clients are not as educated as you on the matter and so can't speak to it. They're just frightened or time to go to cash because an inverted yield curve automatically equals a recession. We're here to show you that that it isn't so lockstep like that. So stay tuned. There is this idea of if the Fed is not acting toward its own rules and that kind of standard hawkishness getting back to normal GOP concerns or etc., then are they just slaves to politics or to what the stock market's doing and all the retirees and their 401ks and everything like that? Are they just slaves to that at this point because it's that kind of equity market rising is a too big to fail phenomenon? Also, oil prices are rising. That bounce back kind of tells us that what the direction should be of a Federal Reserve, but it was different. So all that comes to bear, and it's obvious that we must talk about this new Fed dynamic.
Absolutely. And maybe first we can take a quick look on Hidden Levers and see the scenario itself. Sorry, if I jump in real quick into our scenario library just to show where the scenario is. We moved it into the trending column as this is certainly both the yield curve inversion. Roger, you had mentioned, of course, has been dominating the financial news in the last few days. And then also just these concepts that we're talking about here about the Fed's shift in policy definitely is worth noting. So, of course, from the scenario library, which you can get right from that scenarios menu up at the top right, if you drill in here, we will also post the slides under the scenario as well. And then if I were to go into the data center under economic data, wanted to make a quick note of where to find the economic data that underlies some of what we'll be talking about today, specifically the rates and bonds section. Makes a lot of sense to look at. And here we can see, of course, 10-year yields and the various tenors from 10 years all the way down to 6 months. But we also have several of the spreads. So we talk about the concept of the yield curve inverting, And you can actually see some of that right here, which is, for instance, the 10-year 3-month Treasury spread. If I were to just click on that chart real quick, we can see this recent drop, which has brought that negative. So this is actually what's been getting the news media's attention and what you've no doubt been hearing about. Now, why is this getting as much attention as it does? This drop, because the San Francisco Federal Reserve actually wrote a paper and published that a couple of years ago about how the 3-month 10-year Treasury spread is one of the best predictors of recessions. And every time it's gone negative, there has been a recession somewhere between 12 and 24 months thereafter. So note that lag, and we'll come back to that concept. But anyway, this is where you can find some of that underlying data. Wall Street has traditionally looked at the 2-10 Treasury spread a little bit more frequency and use this as an indicator. And we can see here that it hasn't yet gone negative in this part of the cycle. If we were to go backward in time, we'd see that it had in the past, but it has not yet. So maybe some are watching that one instead of the other 3-month 10-year that has. All right, well, that was just a quick look at where you can find some of the data and the scenario on Hidden Levers. Raj, maybe you can take us into the takeaways for those who don't have a lot of time.
Sure. Well, if you don't have a lot of time, here's what we're going to say for the next 45 minutes. Number one is, I can't say it enough, chiming in on what Praveen mentioned. There is always a gap between the yield curve inversion and recession. So if you saw the news about the yield curve inversion, we'll be talking about how much it matters and is it different this time than the past 60 years? Maybe not. But the point is that some of the best gains in the markets have been between that yield curve inversion moment and the start of the recession. And so, there's historical analogies to this we'll talk about, but that is very important. There is a lag time, and so it isn't head for the hills now. This is happening tomorrow. But you may want to get some things sorted to see the end of the kind of sunset on this business cycle. We know that the Chairman Powell, from some of his statements in the past few weeks, he's admitted to watching the stock market, as opposed to times past, even in the 80s, 90s, that wasn't the case. And so, my thinking is that happened because there's too many people involved in the stock market now because of the 401k system. So, but just know that even Chairman Powell is beholden to that, as opposed to the normal rules that the Fed lives by, the mandate around unemployment and inflation. The current economic picture, it is somewhat mixed. People are hiring, though. Wages are going up, and we do have a decently mixed picture, but somewhat positive actually, and strong. Economy in terms of hiring is still strong, and so does that dovishness, is that warranted? Probably not. You'll see that, and so that's what makes you know that they're beholden to the stock market. And in terms of the larger picture, the debt mountain, whether it's corporate debt or public debt from the federal government, that is just like the fellow in the picture there, kind of isolating us and making us into a place that we can't get out of. Definitely not easily. But so that debt mountain far surpasses anything from the housing crisis or whatever student loan crisis there could be. That debt mountain of federal debt, and it doesn't bode well for future generations. So Praveen, with that, let's start on let's break down the anatomy of a rate hike cycle.
Sure. Why don't we jump in and start there? And we wanted to start by taking a look at the current cycle in comparison to past rate hike cycles. So we touched on this last year, but we thought we would reprise and update it and just look at the fact that, first of all, if you note both in the chart the table at the left and at the chart, you'll see the speed of prior rate hike cycles: 12 months, 11 months, 24 months, sort of as a long cycle in the mid 2000s. That would be this one here, but still relatively fast. Contrast that with the current cycle, which has just dragged out over 39 months, and we're currently paused. We'll see if we ever get another rate hike. Maybe this is the end. Maybe 39 months is a wrap. depending on how things go from here. But I mean, if they restart toward the end of the year, or early next year, then that we might set a record in terms of the longest, slowest normalization cycle in U.S. history. So the Fed raising rates 3x slower than usual, trying to give markets time to absorb the hikes. That's part of it. Even with that, we saw the market volatility, and this isn't just based on what happened in the fourth quarter of last year. As we'll see further as well, this also happened during Chairman Yellen's tenure at the beginning of the rate hike cycle, that there was a lot of this really watching the stock market, but watching markets and looking for volatility, and the moment they see something, pausing and waiting a while before restarting. So very slow, and unlikely as a result to ever get back to, let's say 5%, which was viewed as a sort of neutral bull market rate back in the 80s, 90s, and early 2000s. Seems like we're unlikely to ever, clear those heights at this rate. Well, so Raj, we talked about yield curve inversions, and that's the topic that's on everybody's mind. We thought we would take the rate hikes and break them down in a little more detail and look at, so here we're looking at 5 different previous rate hike cycles based on when they started, whether or not the yield curve inverted, and then what was the S&P drawdown is sort of the important metric we wanted to look at. And with these past yield curve inversions, well, in those 4 cases where there was a yield curve inversion and a rate hike cycle, we see pretty substantial drawdowns. The one time there wasn't, we did not. Now, 5 data points isn't enough to, of course, draw absolutely firm conclusions, but even the research, again, that I'd referenced that the San Francisco Fed did, went back further and covered 9 rate hike cycles, and again, found that pretty stable relationship between when a yield curve inverts and then eventually a recession and potentially market correction as well. So, but you were mentioning kind of a concept around the gap. What's the sort of story there, Raj? And we can kind of see it on the chart. We see the line where the inversion starts and then where the recession starts in gray.
Well, there's a cheaper money, right? We just the same way we've had low rates and a rally through the past decade. There is this instinct from the markets that rates are lower, or there's a rate cut actually happening. There is dovishness, and so let the dollar get cheaper and let equities or risk assets rise off the back of that. We've seen exactly that, not only with equity markets, but with commodities as well. So that being said, it's a head fake, you might say. So because the underlying economy has already turned, and so what's actually happening is that the bond market and the equity market have come unglued, right? They're not saying the same thing, and so the equity market is kind of like, that lag makes it like a wile E. coyote walking off a cliff but still hanging in midair. The bond market telling the real story, not ever really told by some of the financial news networks, but the bond market is, and that's not just a U.S. thing, that's a global thing. One, because treasuries are a global investment, they're the world's lifeboat, and then also just very traditional conservative corporate bonds telling a different story. And so if besides, in this case, we'll get to it later, but besides U.S. treasuries, and where as a safety as a safe harbor, you've also got another safe harbor in the world, which is German bonds in negative territory. I think you'll get to that later. But that's what explains that lag, and it happens again and again.
Right. We see the head fakes on the chart here. We can kind of see it more clearly before the financial crisis, that yields first inverted, in early 2006, and then they sort of inverted and stayed inverted for a while, a little bit later. But still, there was quite a bit of rallying here. The blue line being the S&P. We can see all of this rally going on before the final crash, or the real sort of financial crisis crash. And so, to your point about how and that's why even if we did have a downturn, just to fast forward into that conclusion a little bit, even if we did have this yield curve telling us that the party's almost over this year, that may actually be a signal that the party is over in 2020. And maybe we go on, as we see here, maybe we go on and we go up another 10% or more before the big unwind. So important to keep that in mind, that there is that gap in timing.
One important thing to note here, Praveen, on that chart, if you look at that blue line, that correction is a generational low in 2008, that gray box, right? That is a generational low. That's the worst thing that's ever happened in yours and my career, probably for several of you out there listening. But look at what happened after that. So even after that, that pales in comparison to the gains we've had. And so, in terms of the strength of the American economy, it depends on where folks are, your clients are in their cycle. If they're about to retire, then if we kind of match the highs if we hit highs again, new highs, maybe it's time to take some off the table. But if they're just starting their career, it may be too much gamesmanship of the system for long-term investors, right? So, but I just remember how much of a heart attack that felt like. It lost half its value, and here we are today, a decade later, with not that big a deal.
Right. Yeah, more than, or almost double, rather, the market prior highs. Well, let's look now at, let's talk about the yield curve in a little more detail here. And we thought we would show the yield curve today and really show why the yield curve has inverted, in the current economic scenario. And the bottom line statement there is really the answers to why. It's the 10-year rates, as we'll see in a moment, they haven't really risen in tandem with rate hikes. So this, just so as we look at it, so we know, the overnight rate, so Fed funds rate, is the first data point. Then you've got the 90-day T-bill, 6 months, 12 months, 2-year, 5-year, out to 10 years. That's showing, this is, what's traditionally thought of as a yield curve. You can go out as far as 30 years, but we're looking at essentially 0 to 10 years here. And we're looking at the fact that in terms of the yield curve inversion, that's the fact that these couple of data points are at or above where the 10-year is right now. So that's what we call an inversion, when those data points are higher. So now let's jump backward in time and let's look at 5 years ago. So 5 years ago, we had this kind of yield curve, very much upward sloping. Why? Because we had 0 rates from the Fed, but the 10-year was yielding, over 2.5%, maybe 2.6, close to 2.7. 2 years ago, the Fed had started to raise rates, but we still had the 2-year staying in that, near 2.5, maybe 2.4, thereabouts. So the 10-year is right about where it was 2 years ago. The 10-year hasn't moved, but short-term rates have. And as we continue, we see that story continue. So here 1 year ago, short-term rates keep rising. So we're getting flatter and flatter. So if I rewind, we're getting flatter and flatter because 10-year rates aren't moving up that much. Get to 6 months ago, we're getting even flatter. The 10-year had gotten above 3% at that point, but short-term rates are closing in fast. Now we get to 3 months ago, and we've got short-term rates well over 2% because of the Fed hikes, and 10-year down below 3% now. And then finally, we end up where we are today with this flat to inverted yield curve. And now, that big picture reasoning is because historically, 10-year rates should be more like in the 5% range at this point in the cycle. Then you wouldn't have an inverted yield curve at all. You'd have a very reasonably shaped yield curve. It would look a lot more like that 5 years ago picture where it's very much upward sloping. But because 10-year rates have been stubbornly stuck around 2.5%, the hikes are starting to close that gap all the way until the point now where we got this inversion. So that's sort of, something that's been a little new and different in this cycle is that long-term rates really aren't rising. And that may be for a couple of reasons. That may be because investors are sort of shying away from risk a little bit, and they're willing to continue buying American Treasury bonds at these low rates. They're still willing to buy them, right? So there's some aspect of that. And there's also some aspect of maybe the international markets and we'll talk more about this a little bit later on, but if international markets like in Europe, Japan, other places, if they have very low 10-year rates, then how much can U.S. interest rates diverge? To a certain extent, there's going to be some relationship between, let's say, U.S. rates and other relatively low-risk government bonds in other countries. So the German Bund, for instance, the German Bund is at negative rates right now. So the 10-year German bond actually has a negative yield as of this week. And so that if that's the case, then how high can the U.S. 10-year possibly go? So that that's an argument for other forces that are dragging down the yield curve and causing this inversion. So that's how we got here. Well, Raj, I know you wanted to talk about, if there was we were calling Chairman Powell's Fed the new Fed hawks, and all of a sudden we flipped it around and they're clearly doves now. So what happened? What's the analogy?
Well, we're looking for a time when there was this kind of total reneging where the Fed talked one way and then just totally backed out of it, and was like this random backstepping. And so we did find one. I think Jeffrey Gundlach talked about it. Janet Yellen did not talk about it. She feigned ignorance of the own history of the Fed. That's what I'm surprised by. But the idea was that in 2007, that kind of M-top that we had, if you remember, it's the last time I kept track of the Dow as such an irrelevant number now, but it hit 14,000 that summer, and then we had a little bit of a downturn. But then the Fed just, I remember even just betting a friend on which way the rates were going to go. I thought they were going to either keep steady or rise, and all of it, because of the language that we're using in the FOMC. You can see a link there right to the minutes from those days, August 2007, and they just totally backed out of that. And they said we have a tightening bias, right? And Chairman Powell is refreshingly on that tip as he came in. But then within, I think it was 2 weeks, it's like, do you have your head up your butt to make that kind of change that quickly? Or what powers are at play, or what are you asleep at the wheel? Something like that. Where that's the last time I remember the Fed had such a credibility loss to me that I knew something way different was in the works. And so you see that double top. We did rally back to that, but that was no different than, the firemen walking into the World Trade Center in 2001, this just as the population of the building was exiting. I mean, I don't know who was entering the market then. Definitely a lot of dumb money was entering the market then, unfortunately, for a lot of people. But that did happen, and then you saw the recession start. But you saw a few different things happen, of course, in January. I think Bear Stearns was in March, and the financials as a group were really emboldened in 2006, 2007 because of the housing boom. And so in 2008, they're the ones that had the biggest hell to pay, right? So if that's the case, that part of the analogy, I'm having a little bit of trouble finding what rhymes with the financials to take us down. Just a small recession, you'll see in our scenario that we've introduced, even a recession is very mild. It's just on the other side of zero. But taking it past that, a serious hiccup in the market, or sorry, a cancer as opposed to just a hiccup. What rhymes with the financials? The only thing I can think of is the fangs. We talked about peak fangs before, but really that means all of those coming undone. That means I would say at the top of that list is Facebook, which is halfway done, and then maybe Amazon. The retail picture deteriorating. What do you think about that, Praveen? Do you really think that besides just a head fake rally into a mild garden variety recession, which is just normal after this much of a business cycle push, do you think that anything could take it down further than that, similar to 2007, 2008?
Well, I think that the risk really that the risk now is that relative even to 2007, 2008, the valuations are actually higher today. And so even within a garden variety recession, it would just be valuation compression. And we certainly, if I pivot back for just a moment to HiddenLevers to look at that, and to come back to our scenario library just to make sure you guys are aware of what all is available. From an S&P valuation perspective, which I know is one of our most popular scenarios that we try to keep up to date. Well, a typical recession, because of the extended valuations that we have today, could easily be close to a 30% downside. So that's something that it's a little more pronounced today than it would have been if we were at a lower point in our valuation cycle. But we're not. We're sort of, in CAPE terms, we're second only to the 2000 rally right now. We're still a good bit off that 2000 peak, but we're closer to it than at any other time. So that would be my answer to that question, Raj. I don't think that there is necessarily a particular catalyst of the same magnitude as the financial crisis, but I also don't think that we need some kind of amazing catalyst to just burn our valuations down only because they're so high, so that it becomes easier then to burn 25 to 30% off. Again, not saying that that's necessarily in the cards, but it's not hard to see happen, and I don't think that we need a particularly fancy reason for that to happen.
Part of what made financials kind of internally collapse was the regulatory smackdown, right, of that era, and so and then low rates, the other 50%. So that regulatory smackdown, I keep reading about tech and how that may happen, especially, you have Amazon and Apple entering fintech now, right? They're entering some financial services, and then you have all the regulatory around privacy and sharing, and even on tap might be the ad model going away as a thing, right? The ad revenue model. So maybe that deserves its own war room, but let us know if you guys like those ideas. Really a deeper comparison of 2007 and 2019, where the high flying times before the recession rears its head.
Right. Well, we thought that the next, we've talked now about rate hike cycles and about the yield curve a little bit, and we thought it would make sense to talk about what are the headwinds and tailwinds right now, because there really are some mixed signals out there. So if we start with just talking about some of the actual hard data that we're seeing and some of the maybe contradictions in that data that we're seeing. Initial jobless claims are starting to bounce a little bit. Now you may ask, well, why did we pick out this particular jobs number as opposed to, obviously there are many different numbers you can track. You can track, for instance, the jobs creation every month is a popular number. Non-farm payrolls is typically what's looked at, which also fell sharply in January. But one thing that I know I like about initial jobless claims is it's much more frequent, so you have a lot more data, and it's all the way into March, because this is a weekly number as opposed to a monthly number on a big lag. The irony here is that what we start, well, I shouldn't call it irony, but what's interesting is that you would think that falling jobless claims, this is people filing for unemployment, right? The falling jobless claims is, of course, what happens in a strong economy, that this number sort of trends down and trends down and trends down. What's interesting, what we've found, and we can look at maybe a longer term chart to see it, but many of the recessions in the past have been preceded by hitting sort of a low on jobless claims and bouncing around near that low, and then eventually when you start the trend up, it actually in many cases has preceded the unwinding of the stock market. So not to say that this is a perfect leading indicator by any means, but it's interesting just to see this trend that this is rising now and rising beyond. So a lot of these data points that are from January, you might say, okay, that spike, that is the government shutdown. So we're kind of past that now in this data set, which is why I like it. And the fact that it's still going up, it might begin to say something a little bit negative. So that's on the negative side. We also see down at the bottom left, we see another set of negative numbers, which is the Purchasing Managers Index falling. That's the blue line. So falling below 55. So it's still expanding. So the way the Purchasing Managers Index works is any number above 50 is considered economic expansion. and below 50 is considered contraction. So still expanding, but just not as high as it had been sort of last summer. That August 2018 peak that's marked there. And finally, the green line here is retail sales, which also seems to have slowed down a bit from a peak then. But as we see, that's a volatile number, and it could be, it could just be seasonal volatility or something like that. So don't necessarily want to read too much into these, but they do seem to be slowing down a little bit. So these are the negative numbers. On the flip side over here, we see CPI is relatively moderate. That may actually be one reason that the Fed wants to be a little dovish, is that they want CPI to be closer to 2%. It's at 1.5%. But the employment cost index, and this includes, this is overall employment costs, so it includes healthcare costs along with wages, but both of those are growing, and 3.4% year-over-year wage growth, which lines up pretty well with the employment cost index overall growth over the last year. So those numbers are indicating, hey, employment is still strong. Not only is employment strong, but if employers are raising wages, then there's some underlying strength there. They wouldn't be doing that if they didn't need to retain employees. So that's a counter signal, perhaps. Then there's the fact that oil, now while oil has been correlated to equity markets, it did bounce strongly since those December lows, back near $60 a barrel. So oil prices seem reasonably healthy, and that will start to show up in the CPI numbers as well. So these are kind of counter signals to these negative signals that I was talking about. And so you've got a mix. In short, it's not pointing clearly to this, whereas the Fed has been saying that, all of a sudden, the indicators that we're looking at indicate we need to be cautious. When we see, and this is, of course, just a subset, but even if we look at a larger range of indicators, what we see is it's very much a mixed picture. It's almost the case right now that for every positive indicator, you can find a negative one and vice versa. There's no clear direction that we're seeing that says that, everything is unraveling right here, right now. Well, you were mentioning debt earlier, Raj, and this is sort of in terms of headwinds and tailwinds. This is another one of those headwinds, and I'll mention corporate debt, and then maybe we can get more into the government side of the picture. But on the corporate debt side, this is an interesting chart. This is actually from HSBC. Actually, it's from the Bank of International Settlements, and HSBC was nice enough to make a nicely annotated chart out of it. But what it shows is, over time, how the average debt level of U.S. corporations has continued to rise. So in and of itself, okay, well, maybe we set that aside because we say, okay, it's been rising. That trend is going back decades. So that doesn't necessarily tell us anything by itself. What I thought was more interesting about this particular chart was look how it peaks at or before each recession. And so that to me is interesting because we are seeing what appears to be a peak forming here in the most recent data in the chart, which is from end of last year, that perhaps, if we're hitting another cycle peak here, that would be another indicator that, maybe we are trending down toward the next recession. So that actually is what I think is interesting in that trend. As to whether or not close to 75% of GDP or almost 15 trillion in corporate debt is too high, well, that strikes me as potentially being a problem. Raj, to your point, the U.S. government's debt to GDP is even worse, and maybe from an overall borrowing perspective.
What makes corporate debt a problem? Corporations are taking loans or putting out bonds, and they're doing things with those bonds to push out their productivity and possibilities. What's so wrong with that, Praveen?
Right. Well, that's the question. As long as it's being used productively and profitably, if those companies are managing to drive profits from those investments, then in theory, it's perfectly fine. You do reach a point where potentially your leverage gets too high, and then in the next downturn, all of a sudden you can't afford. And so then you start to get defaults. And that's one of the risks that some of those who are calling that there will be a corporate debt crisis, because you do have some bears who are saying that that's coming. And what they're calling out is that, there's been a lot of lower quality corporate debt issued, and a lot of the covenants that are typically in place have been relaxed in order to issue this corporate debt. And what's going to happen is we're going to see a wave of bankruptcies. So certainly haven't seen that yet, but that's the risk that's being talked about, which is very different from the risk that you're kind of pointing to here in the lower chart on federal debt and what happens here with So you know, we're at World War II levels, right, Raj? But we didn't fight a war.
Yeah, I don't know where that's going to. I mean, I think both during the Obama era of quantitative easing and, well, okay, three eras there. You can kind of see almost three staircases. You know, 1, 2, 3. So if you start in the let's just start with the 2000s, right? We know about the two wars we had there, right? There was debt there. And then starting there, the quantitative easing, giant stair step there. And then for the past 2 years, a smaller step just kind of tucked under that red line. But that will continue to grow, probably equal to this post 2008 era, because of the tax cuts, right? They just won't have as much revenue, so there'll be borrowed money to do that. At a certain point, we have Japan as an example. That high debt to GDP ratio, it doesn't kill a country. I mean, Japan's still very much around, but their economy is becoming less and less relevant, right? In terms of both consumption of goods, some production, but it just is. And so, for our debt to GDP, I think Powell, before this Fed 180, his biggest concern back when he made sense, to me at least, was testifying before Congress. This is in 2019, about the debt to GDP ratio needing to be reined in, and that being the biggest concern for the American economy, for the American future. Praveen, why hasn't it fallen even with the recovery, though? Why haven't we done anything
that's the interesting part of it. Given where we are in the cycle, you'd expect to see some amount of shrinkage, like we saw for instance, in the late 90s. Now, as a result, essentially where we appear to be right now, and of course, like the tax cut is a little bit of some of this bump, we might see a little bit more. So what that's doing is that's preventing it from dropping, because that money's been returned to the taxpayer, which on the one hand did lead to, it definitely juiced growth over the last year and change since the tax cut went into effect. So there's been that positive impact on the economic growth side, but we're definitely not reducing debt to GDP. So the question becomes, are we getting enough growth, in order to sustain this in the future? So far, we haven't necessarily seen it. And so here's the real problem at the end of the day is that, let's say that debt to GDP is flat during the tail end of the cycle, but we just have to remember we are in the strong part of the economic cycle right now. So the moment we hit a rough patch, we can expect, like you were saying, another stair step upward, because if our revenue is not sufficient right now at the toward the peak of the cycle to lower debt to GDP, it certainly isn't going to be when we're in a recession time frame. So that's going to drive it further above 100. For those who aren't familiar with some of the work that's been done on this issue, 100% debt to GDP is kind of viewed as the red line, where long term, and this is kind of going back over literally multiple centuries of research, it was found that once you get over 100% debt to GDP, that's where economies slowly start to stumble, and over time it becomes sort of like a weight around their necks, and in many cases eventually leads to default. Now, it's very difficult, if not impossible, for the U.S. to actually default, because we can print our own money, but the one thing it can lead to is inflation. So you can see that eventually. Doesn't appear that we're close to it. Again, based on the Japan model, to your point, Raj, we're probably not anywhere close. They have a debt to GDP over double this. So we're probably not close to that, but like Japan, do we fall into this trap where the government ends up just monetizing more and more debt, or we end up running up?
Is it the end of the empire, right? The U.S.
is
more singularly in charge now of the world, and so Japan, I would say, was a good number 2, and we all know that during that era it was trying to be number 1, right? We know that, but it is not even number 3 really now. That's the number 3 is disappearing. And so it's just, where is its status in terms of the economic power? We know that back to World War II type deficit spending, right? Where did Britain where did Great Britain lose itself, right? It lost itself in trying all the debt that it was racking up between the war, fighting fascism, and also keeping its colonies. Both of those things at the same time were insane in terms of its debt to GDP, just tacking it on. And then now we know, they've got different problems now, but they were never the same after that.
Right. All right. Well, let's moving on a little bit more. If one of the, we're talking about headwinds and tailwinds here, and one of the arguments, let's call it the bear's argument in terms of headwinds, is that, oh my God, the yield curve just inverted. That, anybody on this call, you're all familiar with that, because that is literally what drove the market late last week into this week, is this bearishness about that as being a key signal. Now, this question as to does the yield curve still matter, this is sort of the bull market case. Bulls argue that the yield curve can be disregarded this time around. That is quite literally the argument. Why is that the argument? So there's two sort of key points to their argument. One is the argument put forward by researchers at the Richmond Fed and working with the New York Fed as well. And what this chart at the top left is measuring is what's called the term premium. So basically, I think most of us are familiar with this idea that the longer term debt you hold, generally speaking, the interest rate is higher, right? It's not lower, it's higher, because the longer term the interest rate on debt, the more risk you're taking, and the longer you don't have access to your money. So time value of money and all, in theory, it slopes upward. And so you do have a higher interest rate that you pay, say, for a 10-year bond than for, overnight lending or 1 year and so on. So that term premium, this is based on research of the New York Fed. They measure that term premium, and what they found is the term premium is comparing the 10-year rate versus short-term average rates, and how much higher is the 10-year than short-term rates based on that measurement. And what they found is that actually, once you control for the average level of expected, short-term rates, that the term premium, so the premium that you get from holding a 10-year versus a short-term bond, it has actually gone negative, and it went negative several years ago, and it's mostly remained negative. So here's the argument. The argument is that if the yield curve, if this term premium is negative, that means that the yield curve is basically just very flat in general. And if it's very flat in general, then an inverted yield curve, where the short-term rate is higher than the long-term rate, it just doesn't mean a whole lot. They're basically arguing that when this term premium gets like this, that the yield curve could invert for any number of reasons, and it's not necessarily tied to anything. So this is one argument they're making, that, maybe it doesn't matter as much as it used to. So that's kind of argument number one. Argument number two is that if you look at German bonds, so German bonds are actually negative right now. 10-year yields on German bonds went negative. And it's only possible for U.S. bonds to yield that spread between U.S. bonds and German bonds. It can only grow so high. So this is going back over 30 years, back to 1986. And we're getting to a point now where we're pretty near the historical highs in terms of the U.S.-German 10-year spread. This is going pretty far back, and this is going back to before the fall of the Berlin Wall. And so this data set is showing that, okay, we're pretty much at the top end of what that spread can be, or at least what the historical data show it can be. And so maybe that's kind of putting a ceiling on how high U.S. 10-year rates can go. Again, that's sort of an external influence that doesn't really have anything to say, or that much to say, about the U.S. economy. So the argument of the bulls would be that because Europe is kind of keeping a ceiling on U.S. rates to an extent, because it is a global financial market, and because of this idea that the yield curve is very flat right now, both of these are being viewed as reasons why, hey, this current yield curve inversion, it just doesn't mean as much as it used to. You can disregard it. So that's sort of the bull argument, that the yield curve doesn't matter. Now, on the flip side, every single time the yield curve has inverted over the last 50 years, I think save once, there has been a recession on average 12 months later. So you can weigh those two sides of the evidence, but this is the evidence, the argument for why it doesn't matter as much as it used to.
Okay.
All right, Raj, so this was something that I know you mentioned up top, but I thought that what was interesting here in this idea of, is the Fed beholden to market or politics? We thought we'd call out two different specific points in time where 2015, 2016, most of you will remember that the stock market hiccuped quite a bit then. That's this line in the back here. This is as rate hikes were just first starting. But as a result of just one rate hike and the seeming softness in the economy, the Yellen Fed held on for almost a year before their second hike. Question is Chairman Powell kind of taking the same approach? So now he got smacked in the face by market volatility and a market drop. Did that cause him to just flatline rates? And is that what he's sitting on, basically, because the market is controlling? What I thought was interesting was we don't have to guess. It's in the transcript of his statements on January 30th. He said, we think about a broad range of financial conditions. He mentions a couple more, but then he says it's the stock market, it's credit availability, it's many, many factors. So he does explicitly mention that they look at the stock market as one of their financial condition indicators. He mentions a couple of others. If we were to pull, and the link is here. So, we're not trying to hide that, but just in the interest of brevity. He mentions interest rates. He mentions currencies. He mentions a couple of other markets, actually, some of whom are, very much tied to the stock market in an of correlation. But stock market, credit availability, so I think he mentions like 4 or 5 total. But just the sheer fact that he mentions the stock market at all as an indicator of what they view the financial health of the country, not to say that it's completely wrong, but certainly it's not part of the Fed's mandate. They're being asked, from a legal perspective, to look at employment and inflation. This is neither employment nor inflation. And so that's what's interesting about it to me, is this acknowledgement that, hey, we do watch the stock market. and I think it does deserve underlining.
I think it's like the movie Being John Malkovich, where, it's like its decisions it should be much more an effect of the Fed, not of the cause of the Fed decision, right?
Right. Yeah. I mean, if anything, the stock market, the stock market is sort of, it's far more volatile than the other indicators. To an extent, it's definitely true that the stock market can impact spending decisions by a certain segment of the population, those who actually, so wealthier investors and those who own investments, perhaps, maybe business owners and those who are making capital investments. So it's not to say that it's not worth anything, but it's definitely like a second or third order effect. It's not a direct measurement of what's going on in the economy in the way that some of the others are. There's so many reasons that stock market valuations can compress or accelerate.
If I can, what we really should, probably, if we're talking about unemployment and interest, inflation, those ideas, we did have a pretty low inflation reading in December. That was a little bit scary. We even talked about doing a war room on inflation right then, not as an emergency, but out of the gate for the year, because it was signaling a change amongst the hawks. But really, if you think about it, that unemployment bit, right now, the last labor report we had, which is earlier this month, based on the first 2 months, it's so hard to interpret, and you have that wage growth, best in a decade, right? Wage inflation is happening. So that's what we call healthy inflation, just like the good cholesterol, I guess. You have a good inflation. It's not runaway commodities and oil prices at the pump. It's wage inflation. People are getting paid more, so prices go up. That's just a very good thing for the economy to rise all around. So, but on the other part of that labor report earlier this month, you've got the first increasing jobless claims in a long time, right? In I think 20 quarters. And so the read of that is very difficult, that labor report. And then not to mention the government shutdown. We had a record long government shutdown, which included all kinds of purchasing decisions and buying propensity that changed, right? That affects a lot of things. And couple that with winter, which already, all of Yellen's tenure, the kind of harsher winters had a heavy impact on her taper decisions, right? Or where they thought the economy was. And it would, of course, average out by Q3. But those things had an impact on that February-March timeframe. And the decisions around then were more murky. And so, if I can, we've definitely assaulted Chairman Powell and the Fed here today in terms of credibility. But if I can take their side for a moment, what I'd say is that that jobs report is really murky right now. You know, between winter, the government shutdown, changing inflation, and then the oil picture that kind of bounced back. You know, it's not an easy job, and I'm just glad that they haven't gone to cutting rates straight up. They still have 1 ounce of hawkishness possible, right?
Well, I think what was interesting was not the pause, because it seems like, you know, if we're talking about an analysis of the Fed's decision for a moment, the decision to pause in January might credibly be based on some of the things that you mentioned, you know, some uncertainty in the employment market, Q1 being a little bit, it's always a difficult read as to how is GDP really doing in Q1. And we've seen time and again underestimates on Q1 growth. And even sometimes Q4 based on difficulty with seasonal adjustment. So there's some issues there. But in terms of what they actually announced in January, not only did they say that we're not raising, you know, likely at all this year, they also detailed how they're going to stop the decrease in the balance sheet. So they went dovish like across the board. If the Fed has multiple levers, if we think about it, they have, of course, interest rates. That's their most direct tool. But they've also got the size of their balance sheet, which has been a very critical tool that they've been using since the financial crisis. And one of the ideas that the Powell Fed, actually even Yellen's Fed prior, had put in place was we're going to slowly decrease the size of the balance sheet. So they announced that they're going to stop doing that as well. So it's sort of, you know, if there were 3 possible steps of dovishness they could take, one is halting rate hikes, another is pausing on the shrinking of the balance sheet, and then maybe the all-in move, like you said, Roger, would be to cut rates. Well, they did 2 out of 3. And so that was where it's a little bit interesting. It's not like they took 1 step toward dovishness. They went most of the way in that direction. And that's why, as you say, it was a 180. And probably a little bit surprising to the market, initially to the upside. Now maybe the market is looking at it and saying, okay, wait, why are they doing this? Maybe this is,
yeah. And the thing though is it's things that make you go, huh? And so for us, I feel like they are beholden to market and politics because, you know, Chairman Powell's own attitude coming in, it was a very breath of fresh air, frankly, from the serious dovishness. You know, if you believe in the old normal, what Mohamed El-Arian calls the old normal, GDP and 10-year rates kind of correlated and those rising together, and that makes a good country or a strong economy, right? That's a solid thing. And so getting off the kind of the borrowed money teat was a fantastic idea. And so I can't even believe that the Fed chair kind of broke here. And so I'm just wondering, you know, is there, I think Gunlock called it gaslighting, just kind of not really telling the truth about what they're beholden to, right? And so that's what sometimes makes me think
why I think it's
maybe it is just politics, who knows?
Well, you know, that's why I thought it was interesting that it was, you know, and to his credit, Chairman Powell has had these press conferences where he's much more conversational, and so maybe that's why he went ahead and said it. At least he admitted that the stock market is part of the equation. So, you know, that's positive. Well, let's talk about the scenario now and how we've changed and introduced the new scenario, Raj.
Well, if you remember back last spring, the new Fed Hawk scenario was on the books here. We did a war room about it. The good, bad, ugly there is to the left. You know, we talked about Fed popping the kind of asset bubble there the same way they did in '87. The old normal, which I just referenced, actually, you know, GDP kind of helping 10-year climb back up to its historically normal levels, somewhere comfortable in the 4s and 5s, low 5s. And then on the ugly side, yield curve inversion. And at that time, we really talked about 2s, 10s, because there's several durations, of course, of U.S. Treasuries. And so 2-year and 10-year were the things that we concentrate on. I've been hearing lately to concentrate more on the 3s, 10s, Praveen. What do you think about that?
Right, the 3-month 10-year. Yeah, and that was what we talked about earlier, the fact that some of the more recent research has shown that the 3-month 10-year is the one worth watching. And so that's actually why we have added the 3-month 10-year to the indicators that you can watch in the data center, as I had shown earlier.
Okay, well, fantastic. Well, so it becomes quite obvious that, you know, I think I think we are quite busy at Hidden Levers. You know, we have a whole business intelligence initiative going on here that got announced this week, and you know, our team is I would call them superstars, but they are still mortals. So there's only so much we can do, and so it was quite ripe to introduce this new scenario and retire that Fed hawk scenario. And just looking at the picture and the text there, it makes me realize like that is a history now. You know, that's not even where we are. So that back to if we have anything, I think we were on the arrows there because we were on our way to the good scenario. And so, but you know, now that abrupt turn has happened, we have to replace that. That I would say is no longer valid. So Praveen, why don't you take us through what these scenarios look like, these outcomes?
Right, and so the new updated Fed's dead, which is available as we looked at earlier in Hidden Levers, and it's in the trending scenarios. So from good to ugly, if we want to start at the top with the best possible case, and that's that it really is a temporary, so some of the data that we've seen, the mixed data is really sort of a temporary hiccup. And really what we see going forward is continued strong growth. So over 3% going forward. CPI rises. Oil prices have already rallied back to $60. So certainly it's possible that we get that kind of target inflation. Now maybe
that's the thing. They cited oil prices in their decision making, but oil prices have bounced back up. So does that mean that should make them less dovish, right? But it didn't. They doubled down.
Right, and so in theory, if that drives the CPI back up, maybe we do get back to that more neutral footing. And then the projection here, you know, from an equities perspective, is more of a typical, reasonably strong year. You know, roughly in line with long-term average S&P growth, a little bit more bullish than that, but not a whole heck of a lot. And that, interestingly, you know, so that really is a story where this economic cycle is going on for potentially a couple more years. So it's not scheduled, you know, it's not ending in 2019, not necessarily ending in 2020. Whereas this middle case, decelerating GDP growth, and here's what's interesting to me about this decelerating story. This is the idea that, okay, yield curve inversion has happened, but maybe it's less of a big deal than it used to be for some of those previously mentioned reasons. If that's the case, maybe it hits us more like it's hit Australia and some other countries. So in other countries around the world where this has been researched, the yield curve inversion, it doesn't necessarily point to a recession, but it could point to a slowdown, sort of a mild hiccup. And so that's what we're looking at here. This 2350 level on the S&P, for those of you who recall, this is roughly the level of the lows of last October, November. So retesting those lows. So that's really, you know, in that context, that's not a huge drop from today. 17% is still not a bear market. With a temporary shrinking in U.S. GDP growth, but not a true recession. And then finally, we have the ugly, which, Raj, this idea of this double top. This is more the idea where potentially the market does go up somewhere in the near term, but true to the form of what the yield curve has predicted in the past, somewhere toward the end of 2019 or early 2020, we do actually have the end of this business cycle and a recession. And because of the elevated valuations that we have right now, the drawdown could be substantial. So 35% S&P in that 1800s range. And that's just based on valuation compression as much as anything in a recession, which you'll tend to see. So we might rally a little bit. The double top in a recession idea is that maybe we rally a little bit because of this temporary dovish Fed before the market realizes that, oh, wait, they were being dovish because things are actually getting bad. And then we head south. And then a mild GDP recession, minus 0.1, much more in line with traditional recessions, not a 2008 style meltdown. Back to that point, Raj, that we don't need to have the wheels totally fall off any particular sector to see a reasonably strong correction just based on valuations.
Yeah, and I mean, we've talked about that a few times here. We notice risk products are now very much part of the advisor community. It's not just us alone, or riskalyze for some people, or maybe BlackRock has some tools for some people that want to compromise their fiduciary duty. But whatever that is, risk products are here, and so it's part of every conversation now for in a client agent relationship. That risk, the sophisticated risk conversation. So, but we will say again, stay away from talking about the financial crisis, drawing everything back to that. I think we had a war room called Financial Crisis PTSD last year, and so you're better off talking about garden variety recessions, things like that. If there is something that can take it beyond that 1830, which would be just a recession, a garden variety recession, it's probably something that is way bigger than a way bigger cancer that like financials were in 2007. So there is a murky kind of similarity between the high flyer tech companies now and the high flyer financials in 2007. But we'll dig deeper. Let us know if you'd like to see that as a really deep comparison between those two eras, because there are parts of it that fit, and how the Fed behaved is at the top of that list.